Thank you.
Okay, in a bit we'll get in Pramod Gubbi, and my producers will of course alert me once Pramod Gubbi is on. But well, just want to one more set of round of stock spotting before we get in Pramod Gubbi in this conversation. Remember, Badani Bar is starting off weak. Ambuja Cement is staying strong. Bajaj Finance is 2100, and ICICI Prudential is looking slightly wobbly in trade. So do watch out for all of these names. Okay, Pramod Gubbi Johnson with his thoughts. Pramod, so good having you. Thanks for joining in. Well, the high. What's your sense, Pramod? A lot of people look at 2008 and look at bounces that happen in a bear market as well. What is your sense? I'm not asking you to give me a tactical trade, but I'm just wondering, do you think the pain is behind us, or is it even possible to predict that?
Yeah, I think the latter is right. It's pretty much impossible to predict that. Look, short-term stock price prediction is always a challenge, and more so in a scenario like this where nobody knows what's going to happen. Right? So whether it in terms of the virus or the related effects in terms of the slowdown in economic activity or the complete halt in economic activity, neither do we know when we will reach the bottom in terms of cases. Yes, the recent data suggests that the number of cases, daily new cases across the world is slowing down or coming off quite consistently. Therefore, there are hopes built about the sort of stringent lockdown measures being lifted sooner or later. But then, there talks about a rebound and stuff. So we don't know. Given we don't know, and particularly in an atmosphere like this where there's plenty of liquidity floating around, that makes it virtually impossible job to predict the market in the short run. In the short run, typically you have stock prices driven by two factors. First is the sentiment. Sentiment again will be driven off whether we will see an improvement in the number of cases and therefore the lifting of the lockdown. More importantly, I think liquidity, the sheer amount of liquidity that's been pumped in by central banks globally. It's been a surprise rally because there is absolutely no change on the ground in terms of economic fundamentals. Yet the stock markets are suggesting a rally, and that can only be attributed to liquidity. So that makes it again a big challenge for anybody to fight the market on liquidity. Having said that, I think if you are like us, at it from a longer term perspective, in the long run, prices will have to converge to fundamentals. I think in the long run, you're better off betting on companies which don't have existential challenges. Irrespective of how the short run will pan out, how long it will take for the economic activity to come back, if you're betting on the few that will sustain this crisis, then you're still better off from a longer term perspective.
I wonder, from the monies that you might be getting, or if you are sitting on cash, Pramod, what are you doing? Are you looking to deploy at every opportunity, or are you waiting for some down days that could come in because of global factors or otherwise? I know you said you can't time, but still just thinking out loud.
No, exactly for that reason, we don't take any cash calls. We don't try and time the market. The only factor we consider before making a purchase is if the price at which the stock is available today in the market, is it significantly below our conservative estimate of its fair value with a significant margin of safety. As long as that criteria is met, we go ahead and buy the stock. It doesn't matter if the stock were to be available 10% lower tomorrow, because we don't know. But given the market situation, I think a lot of the stocks, in fact, all the stocks that we want to buy are fulfilling that criteria, i.e. that the current market prices are significantly below our estimate of their fair values. So therefore, with a 3 to 5 year view, we're going ahead and making those purchases.
Interesting. So aside of those high quality financials, and I think the last time that Saurabh was here, Saurabh was telling us that you are also looking at the second run financials wherein the price damage was very severe. But what other pockets, Pramod, are you seeing valuations where there is possibilities of growth, but valuations at a stark discount to averages?
Well, I guess, For a consistent compounders portfolio, we haven't really made any changes at all, and in the near term, it's unlikely. But for some of the other portfolios where we do take a little bit of a tactical stance, we are looking at potentially autos. Autos again, a sector where prior to the crisis, the balance sheets were pretty strong. Unless and until you have a view that the world will change structurally post-crisis, which we don't share. We believe some of these franchises will be able to survive the crisis. There are no existential challenges, and on the other side of the crisis, whenever the recovery happens, they are likely to take a meaningful share of that recovery. So autos, perhaps one sector where we are looking at very closely. Similarly, in pharma and IT as well, again, may not be affected massively by this downturn, but there again, balance sheets have been strong even prior to the crisis. So there are no existential challenges again. So the only thing that you need to assess before making your shopping list is will the crisis have an existential challenge for the company in question or not?
How are you seeing the performances of some of the cement plays? I mean, it's a sector that was in doldrums. A lot of people believe that if any activity has to happen, it has to be infrastructure related, will happen from the government, and the only way you can play it is through cement. The valuations are reasonably good, and the results on the cost control front from the two Holcim Group companies seem to be okay right now, Pramod.
Yeah, so look, I mean, cement is clearly a cyclical sector. Although infrastructure has supported some of the cement volume growth in the recent past, the bulk of the growth or the sustainable growth will have to come from housing and real estate. So until unless we know when that recovery will happen, it's not really clear whether there'll be a sustainable rally in, or at least cement volumes picking up. Infrastructure alone, I don't think can carry. It requires significant spending from the government. The government has done its bit over the last few years, but for a sustained recovery in cement volumes, you will need housing to come back. I mean, the country needs housing to come back for many more reasons, but certainly for cement. There are a few good quality cement companies, but given the cyclicality of demand, it sort of at least doesn't make the cut for a consistent compounders portfolio.
Okay. There is some serious moves happening within specialty chemicals, Pramod. I don't know. You guys have a couple of these names, I know, may not be specialty, maybe normal chemicals, but you have some exposure there. But these stocks are not trading at any kind of discounts and still are seeing some serious buying. RT Industries, a case in point today. Alkyl amines inched up quite significantly the last few days. So chemicals, specialty chemicals, seeing some serious buying. Do you think there is a method to the madness here?
Well, again, just stepping away from the short term, some of the drivers for specialty chemicals were anyways underway even before the crisis began. This is perhaps one of the few sectors in India where manufacturing can see some success because you don't need large tracts of capital. It's not that capital intensive where we tend to lose out on some of the other East Asian countries. Nor do you need large volumes of labor, where again we become less competitive compared to our Asian peers. There is an element of science and technology involved, which is where we score the best, and hence specialty chemicals or chemicals in general tend to come up. Now, given this crisis, given that chemicals was a large part of the Chinese manufacturing for the West, and given the West has experienced some sort of a disruption by its heavy reliance on China, there's clearly more talk about how capacities could move from China to India. And India has clearly established its credibility. So given the stark difference in the size of the industries in China and India, even a small shift in that capacity towards in India can provide a significant growth impetus for specialty chemical players. But within that, having said that, you still need to pick the right ones. Obviously, the same issues that concern China, which was environmental norms and so on, could also impact some of the Indian players. So therefore, before going out to buy blindly, you need to establish whether there are sustainable franchises in India as well. There are a few. We own a few. But I think that's clearly the driver that's pushing these stock prices up.
Pramod, I have one last question. Based on the developments, the uncertainty around the lockdown extension or what have you, are there pockets that you were bullish on earlier where you guys have changed your stance?
Not really. I think the only sector that's gone up is the staples sector, and we're not changing our stance there. So the couple of staples companies we own, we're quite comfortable with those, because here the demand positive is longevity of demand rather than the short-term demand.
Pramod, can you explain? Sorry, I missed out the answer.
Yeah, so I was suggesting that more than the extent of demand is the longevity of demand for staples, right? Because we're still a third world country with significant number of people living on essentials. So given the essentiality of these products, we're likely to see a really long growth runway for this sector. So despite the fact that it's run up somewhat, we don't think there's a case to say that enough is enough on FMCG or staples in general. So no, I mean, in short, I don't think our views on any of the sectors, either from a demand perspective, certainly from a demand perspective, has changed. More importantly, I think even in these sectors, you will see consolidation driven by the crisis, because the crisis will certainly hurt the weaker companies in every sector, and therefore the 2 or 3 market leaders or who have very strong competitive positions will come out stronger on the other side of this crisis, and therefore that higher market share will mean higher growth despite overall growth not being that high. So we remain quite stable and static in terms of our portfolio and our views on the different sectors.
Okay, Pramod, we'll leave it at that. Thank you so much for taking the time out and giving us your perspective. Really appreciate your time.
Thank you.
Well, viewers, who would have thought the bank nifty staying up 2% higher, but the indices are coming off, and I reckon part of it could well be Reliance. And remember, I was talking about this in the morning on the show, that while Reliance looked good from a technical perspective, oil coming off and a rights issue would all not augur well for Reliance Industries, and that's what's happened. We've had a bit of a dip in Reliance Industries in the session today. So, I mean, not to pat my back, I'm just trying to say that sometimes you just got to apply some logic to the overall piece as well. What's doing well is IndusInd Bank 10% higher and Axis Bank 3.5% higher. I must say the juice around Max has completely disappeared. Max Financial is back in the red, but if a deal were to be announced, then this could be interesting for Max Financial. So keep that stock on your radar. But we have to wrap it up on this leg of Indian Open. Thanks so much for watching. I would urge all of you though to tune in about a few minutes from now. We'll be talking to Nimesh Shah of ICICI Prudential Mutual Fund to talk about his view on the debt funds issues after the Franklin Templeton fiasco. A lot of you wanted to hear. We are getting you one of the largest players in that space to talk about it. Stay tuned, or rather tune in a bit later on in about 3-4 minutes on BQ Live.